Well, a very interesting as well as an important note coming in from Morgan Stanley. The analyst, or the economist rather, is Upasana Chachra, and what she is saying is that it's a very interesting note that she's come out with. She's saying that the best of easy monetary policy may actually be behind us. So what Morgan Stanley is saying is that they are expecting RBI to now keep interest rates on hold as they expect the growth to recover and inflation, again, the key trigger point here being inflation, to remain above the 4% mark. What they're saying is that they're expecting a quick recovery in growth can actually pose upside risk to inflation. So as the economy recovers, they're expecting that the quick recovery in growth can actually pose upside risk as far as the entire inflation targeting is concerned. What they're saying is that they're eventually expecting RBI to take the call rate closer to the repo rate as the growth recovery strengthens. In terms of supply side factors, commodity price rise, these are the key factors that are actually pushing the inflation higher. What she is saying, or what Morgan Stanley is saying, is that the headline inflation has actually been trailing above the upper tolerance level of 6% for almost 10 consecutive months, except for a small marginal dip of 5.8% on a year-on-year basis in March 2020. So this is after averaging close to or below 4% since 2017. So again, the factors or the significant trigger as far as lower inflation is concerned, as far as inflation targeting is concerned for the RBI, is now actually above the comfort or the tolerance level, and which is why they believe that interest rates may be kept on hold. The underlying drivers of elevated inflation levels, as per them, are actually supply-side disruptions and cost-push inflation. Decomposing the inflation data, what they are actually seeing is that the food, fuel and other commodity groups actually accounted for almost 60% of the total rise in inflation. So what they are saying, monetary policy stance, while it remains very accommodative with the call rate near the lower bound of the policy rate and the real call rate on CPI and call rate on core CPI, both at an 8-year low. So they believe that the sticky trend in inflation reading, coupled with their expectation of continued growth recovery, implies that rate remains on hold now. They believe that as growth recovers in 2021, a neutral policy rate will also have risen, and the RBI will have to think about taking the effective policy rate that would be closer to the repo rate. So even so, real policy rates, while they remain in negative territory, indicating an accommodative policy stance. So what they are saying, they are actually talking about their entire bond portfolio. They are quite bullish as far as the INR is concerned, because they believe RBI could allow the rupee to catch up with the broad dollar weakness to reduce domestic inflation.